How to pick the best stocks to buy. What if I told you that picking great stocks doesn't require a finance degree? You don't need insider access. You don't need to spend all day watching CNBC or reading complicated charts. All you need is a framework, a simple, repeatable process that helps you make confident decisions. In this video, I'm going to walk you through that exact process, step by step, in plain simple English. So if you're trying to figure out how to find the best stocks to buy, whether you're just getting started with investing or you've been buying stocks for a while but want to sharpen your approach, this video is for you. Let's break it all down. 1. Know your why. Before we talk about any stock, we need to talk about something more important, your goals. Why are you investing? Are you investing for retirement, hoping to build long-term wealth? Are you looking for passive income, maybe through dividends? Do you want to grow your money quickly, even if it means taking more risk? Or are you just trying to protect your savings from inflation? Maybe you want to make a little extra on the side. Or maybe you have a long-term vision of becoming financially independent. Whatever your reason is, it matters, because your investment goal should shape your entire strategy. For example, if you're focused on income, you might look for dividend-paying stocks. If you're in your 20s and have time to take risks, growth stocks might make more sense. If you're approaching retirement, stability might be more important than rapid growth. So before you pick a single stock, get clear on your why. That's the foundation. 2. Fundamental analysis. Once you're clear on your goals, it's time to look at the company behind the stock. This is called fundamental analysis. You're not just buying a ticker symbol. You're buying a piece of a business. And smart investors want to know how that business is doing. Let's start with earnings per share, or EPS. This number tells you how much profit the company is making for each share of stock. If EPS is growing year over year, that's a good sign. It means the company is making more money. Next, look at the price to earnings ratio, or PE ratio. This compares the stock's current price to its earnings. A high price to earnings ratio could mean the stock is overpriced, or that investors expect strong growth in the future. A low price to earnings might mean it's undervalued, but it could also mean the company isn't growing. So context is key. Compare the price to earnings ratio to other companies in the same industry. Then, examine revenue. Are sales increasing over time? You want to see upward trends in both revenue and profits, but also pay attention to profit margins. A company might be selling more, but making less money per sale. That's not ideal. Next up is debt. How much debt does the company have compared to its equity? Too much debt is risky, especially in a rising interest rate environment. You want to invest in businesses that can survive tough times. Also, ask yourself, does this company have a competitive edge? Something that sets it apart from the competition? This is called a moat. Companies with strong moats are harder to compete with. Think of brands like Apple, Google, or Amazon. They're dominant because of technology, brand loyalty, or network effects. That's what you're looking for, a business with staying power. 3. Technical analysis. Once you've found a company with strong fundamentals, it's time to figure out when to buy. That's where technical analysis comes in. Now don't worry, you don't need to become a chart expert overnight, but knowing a few simple tools can really help you avoid buying at the wrong time. Start with the moving average. This tells you the average stock price over a set number of days, like 50 or 200 days. If the current price is above the moving average, that's a sign of strength. Next, look at the RSI, or Relative Strength Index. This shows whether a stock is overbought or oversold. If the RSI is above 70, the stock might be overbought and due for a pullback. If it's below 30, it could be a buying opportunity. Another helpful tool is the MACD. It helps identify changes in a stock's momentum. You don't have to use every tool out there, but a few key indicators can help you enter a position more confidently. Remember, even a great company can be a bad buy if you buy at the wrong time. Technical analysis helps with that timing. 4. Industry and economic context. Now, let's zoom out even more. Even the best stock can struggle if it's in the wrong industry or caught in a bad economy. So ask yourself, what's the big picture? Is the industry growing? You don't want to invest in a dying sector, even if the company looks good on paper. For example, would you rather invest in a DVD rental company or in a streaming platform? Exactly. Industries matter. Look for areas with long-term growth potential. Right now, that might be AI, renewable energy, health tech, or cybersecurity. Then consider the economy. Are we in a recession? Are interest rates rising? How's inflation? Some companies thrive in downturns, others don't. So make sure your stock fits the current economic environment and be prepared to pivot when things change. 5. Value stocks versus growth stocks. Next, you need to understand the difference between value stocks and growth stocks. Value stocks are usually established companies that are trading at a lower price relative to their earnings. They often pay dividends and offer stability. Think of companies like Coca-Cola or Johnson & Johnson. Growth stocks, on the other hand, are newer or rapidly expanding companies. They may not pay dividends, but they're reinvesting profits to grow even faster. Think Tesla, Shopify, or other tech-focused brands. Growth stocks can deliver big returns, but they're more volatile. Value stocks are steadier, but typically slower to grow. Which one is right for you depends on your risk tolerance and your goals. You can also have both in your portfolio. That's the beauty of investing. You can mix and match based on what works for you. 6. The power of diversification. Let's talk about one of the most important principles in investing: diversification. You've probably heard the phrase, don't put all your eggs in one basket. That applies 100% to investing. No matter how much you love a stock, never put all your money into it. Even the best companies can run into unexpected problems. That's why you spread your investments across different sectors, industries, and even countries. Own some tech, own some healthcare, own some energy, own some small companies, and some large ones. Diversification doesn't guarantee profits, but it does protect you from major losses. It keeps your portfolio stable even when one part of the market takes a hit. It's about playing defense while still playing offense. 7. Staying involved. Buying a stock isn't the finish line. It's just the start. You need to monitor your investments. Not every day, not obsessively, but regularly. Check in during earnings season. Read the company's quarterly reports. Pay attention to major news. Is the company still growing? Is the leadership still strong? Are they innovating or just coasting? Sometimes the right move is to hold. Other times it's to cut your losses or take profits. Smart investing is about making adjustments along the way. It's an active, evolving process. 8. Watch out for red flags. Let's be real. Not every stock is a winner. Some look good on the surface, but have serious red flags. Here are a few to watch for. If earnings are consistently declining, that's a concern. If a company is drowning in debt, that's risky. If the leadership team is constantly changing or facing legal trouble, be cautious. Also watch for insider selling. If top executives are unloading their shares, it could be a warning sign. And finally, be careful with hype. Just because everyone on social media is talking about a stock doesn't mean it's a good investment. By the time the masses find it, the opportunity might be gone. Stay grounded. Stick to your research. Tools you can use. The good news? You don't have to do this all alone. There are tools that make the process easier. Yahoo Finance is great for basic research. Finviz.com offers excellent screeners to help you filter stocks by performance, sector, and fundamentals. Seeking Alpha has tons of analysis from real investors. TradingView is fantastic for charts and technical indicators. Apps like Robinhood, Webull, or Fidelity can help you monitor your portfolio on the go. You've got more resources at your fingertips today than ever before, so take advantage of them. Finally, picking the best stocks to buy isn't about guessing. It's not about chasing the news. It's about following a process. Know your goals, study the fundamentals, understand the trends, diversify your holdings, and keep learning. You're not going to get everything right. No investor does. But if you stay consistent, if you keep asking good questions, if you stay patient, you'll win more than you lose. You'll build wealth over time. And that's the whole point. If you found this breakdown helpful, hit that like button right now. It helps more than you think. And it tells the algorithm to show this to more future investors like you. Subscribe to the channel if you haven't already. Turn on notifications so you don't miss the next video. We've got more investing guides, market insights, and real stock breakdowns coming your way. And hey, if there's a stock you'd like me to analyze in an upcoming video, drop it in the comments. I read every single one. Let's build your portfolio together, one smart move at a time. Thanks so much for watching. I respect your time. I respect your hustle. And I believe in your ability to create real wealth. Until next time, stay focused, stay informed, and stay invested.